Welcome back to the channel. This week was a reminder that markets can look calm right before they get jumpy. Today we will talk about the Fed pause, political heat around central banks, and fresh growth signals on both sides of the Atlantic. So let's start with the biggest story of the week. The Fed held rates steady, and traders immediately tried to game the next move. Stocks flirted with new highs at points, but the vibe was not pure celebration. It was more like everyone was scanning the room for the next warning sign. The message investors took away was simple. Rates may not be moving today, but the path for 2026 is still wide open. And that uncertainty matters because when policy is on pause, every data print and every headline can move the goalposts. Now, here is what matters. A steady Fed does not automatically mean an easy rally. It means the market has to do more work to justify prices. The other shockwave was political, not economic. A new pick for the next Fed chair dropped into the middle of an already tense debate about central bank independence. Markets hate one thing more than bad news, and that is uncertainty about the rules of the game. Even if policy does not change overnight, the mere possibility of a different direction can force big investors to rethink their risk. So what does this mean for us? The rate story is no longer just about inflation and jobs, it is also about governance, credibility, and the future reaction function of the Fed. US data is back in the driver's seat, and it is whipping rate expectations around like a storm. Every new print forces the market to reprice the path for cuts, and that is why bonds and equities feel so jumpy right now. Now look at this chart, the 2-year Treasury yield, DGS2, versus the Fed funds rate, FED funds. And this is exactly why traders have been so jumpy lately. The 2-year yield is basically the market screaming its expectations for where policy is going next, and it has been moving fast. When DGS2 runs above the Fed funds rate, it is the bond market pricing tighter for longer or at least fewer clean, easy cuts. And when it slips back down, that is the market trying to breathe again and price in relief. So every hot or cold data print is like throwing gasoline on this line because rate bets get repriced instantly. And the scary part is, the bond market is not waiting for the Fed to confirm it. It is trying to force the narrative first. Next up, the 2-10 yield spread, T10Y2Y, and this thing is basically the market's mood ring for stress. When this spread is deeply negative, it is the bond market saying policy is tight enough to choke growth later on. And that is why every big data surprise hits so hard, because it can steepen or deepen the inversion in real time. If the spread starts climbing back towards zero, that is the market quietly whispering soft landing again. But if it stays pinned or dives, it is risk aversion taking over, and suddenly everyone is hedging like something is about to snap. So even when stocks try to rally, this chart is the cold reminder that the rate story is not done yet. Europe just dropped a growth surprise, and it matters more than people want to admit. If the euro area is holding up better than expected, that can force global markets to rethink the easy narrative that Europe is the weak link. Now let's put a chart on it. Euro area real GDP, quarter over quarter. This bar chart shows you exactly why traders had to wake up, because the euro area is not collapsing the way the doom narrative expected. When growth prints come in stronger than forecast, it forces markets to reprice Europe from dead money to at least somewhat investable. And that has global consequences, it shifts flows, it tightens financial conditions elsewhere, and it complicates the whole rate cut story. If this momentum holds, the ECB gets less room to move fast, especially with inflation still lurking in services. Bottom line, Europe is suddenly part of the risk equation again, not just background noise. And just when markets wanted to breathe, inflation stepped back into the spotlight. Even small upside surprises in price data are enough to slam the brakes on rate cut optimism because nobody wants to relive the inflation whiplash. So the mood shifts fast. Risk assets can rally on growth, but they hesitate the moment inflation refuses to cooperate. Now look at this CPI chart, year over year, headline CPI versus core CPI. Headline inflation can cool and re-accelerate with energy swings, but core is the one that keeps the Fed up at night. And when core refuses to drop cleanly, the market starts panicking about rates staying higher for longer. That is why every inflation print feels like a trapdoor under risk assets. If core inflation stays sticky, cuts get delayed, bond yields stay jumpy, and equities lose their safety net. This is the exact reason inflation fear just refuses to die. Next, look at housing through the Case-Shiller Home Price Index, and this is where the inflation story just refuses to go away. Even when headline CPI cools a bit, shelter is the slow-moving beast that keeps the whole system tight. If home prices stop falling and start climbing again, that feeds straight into rent pressure with a lag, and suddenly the disinflation narrative gets shaky. And that is exactly why rate cut dreams keep getting pushed back whenever housing looks resilient. In a nervous market like this, any hint of a housing reacceleration is basically a warning flare for inflation. Now zooming in from the macro headlines, let's look at the SPY, the SPDR S&P 500 ETF trust that tracks the S&P 500. This trend channel view shows the market still riding inside its broader uptrend, but with price action pressing into a zone where the rails of the channel start to matter a lot. But here is the key point. When everyone is debating the next move in rates, even a clean uptrend can feel fragile because it only takes one ugly day to test the lower channel line. Watch those obvious reference points on the chart, including the channel support and nearby major moving averages like the 50 days, because a confident bounce keeps the bull case alive, while a slip below them is how cautious weeks turn into risk-off weeks. This ties back to the Fed pause and the political noise this week, because the SPY is still pushing higher, but momentum is quietly leaking. On this chart, price just printed a higher high, while RSI printed a lower high, and that is classic bearish divergence. But here is the key point. That does not mean crash tomorrow. It means the rally is running on thinner fuel, and any break of short-term support can flip the vibe fast. So, if buyers cannot defend the recent swing lows, the market can slide into a deeper pullback even while the long-term trend still looks healthy. At the same time, the SPY is flashing that dangerous kind of calm where the market looks stable, but pressure is building underneath. The TTM squeeze is O on, which means volatility is compressed and the chart is basically loading a spring. But here is the key point. The short-term bias is still bullish, yet you do not front-run this. You wait for confirmation with a close outside the Bollinger Bands. With the VIX staying under 20 for multiple sessions, traders are getting comfortable, maybe a little too comfortable, and that is exactly when surprise moves tend to hit hardest. Now zooming in even further, this SPY chart is basically screaming one thing: plan the pullback before it happens. A clear down impulse was detected, and price is still trading inside that A to B leg, which makes a reflex bounce into the Fibonacci retracement zone statistically likely. But here is the key point. The 38.2 to 61.8% zone is where traders get trapped, because it feels like the rally is back, right before sellers hit it again. So, if we do bounce, watch how price behaves into those fib levels and around the 50 days, because that is where the market will show whether this was just a shakeout or the start of something uglier. Switching gears to the QQQ, the Invesco QQQ Trust that tracks the NASDAQ 100, and this is where the market mood gets extra twitchy. The chart is printing an ascending triangle, which is one of those patterns that can explode higher, but only if buyers actually show up with conviction. But here is the key point. With traders still digesting the Fed hold and the latest growth in inflation signals, breakouts are not guaranteed, they are earned. So watch the flat resistance line on that triangle, because a clean break can ignite a chase, while another rejection is where the cautious tape turns into a fast tech sell-off. At the same moment, QQQ is also flashing a volatility warning, because the TTM squeeze is ON and that compression has already lasted 2 sessions. But here's the key point. Squeezes do not stay quiet, they eventually release, and when they do it is usually violent. The short-term bias is still bullish on this signal, but you want confirmation, meaning a decisive close outside the Bollinger Bands. If this breaks upward, the NASDAQ can rip higher fast, and if it breaks down, it can turn into one of those sudden air pocket drops that catches everyone off guard. Meanwhile, the QQQ momentum gauge is sending a cold little warning shot, because RSI has slipped below 50. But here is the key point. As long as RSI stays under 50, rallies are more likely to get sold into, not chased. That is exactly the kind of tape we saw into month end, where the market looks fine on the surface, but traders are quick to hit the sell button. If QQQ can reclaim RSI 50 fast, it is a sign momentum is recovering, but if it stays stuck below, this triangle can break the wrong way. To wrap this index chapter, QQQ is also flashing a short-term cooling signal, because the stochastic oscillator just exited the overbought zone below 80. But here is the key point. That is not automatically bearish. It is the market telling you the easy upside momentum is fading and price may need to digest. In a cautious tape like this, that digestion can turn into chop, or it can turn into a sharp flush if sellers press. Watch how QQQ behaves around key support in the 50 days, because that is where the next big tech move will be decided. Now shifting into the risk barometer, let's talk Bitcoin, ticker BTC, USD, the world's biggest cryptocurrency priced in US dollars. Today's close is the lowest in the last 20 trading days, and it has now closed below its 50 days moving average for 11 straight sessions, which is not what you want to see in a confident risk-on market. But here is the key point. When Bitcoin is bleeding like this, it often signals that speculative appetite is fading and traders are getting defensive. That fits perfectly with the broader cautious mood where stocks look calm but the under-the-surface risk is building. Watch the 50 days like a hawk, because reclaiming it would be the first real sign the fear is easing. This ties back to the bigger market psychology, because this Bitcoin chart is showing a clean down impulse, and that is never a feel-good signal. Price is still trading inside the A to B leg, which makes a reflex move into the Fibonacci retracement zone statistically likely, basically a bounce into the 38.2 to 61.8% area. But here is the key point. That bounce is not a victory lap, it is a decision zone where weak rallies often get sold hard. If Bitcoin cannot reclaim key levels and hold them, the market is basically telling you risk appetite is still on life support. Meanwhile, this Bitcoin candle is giving us a tiny flicker of hope, because a hammer just formed right at a potential support zone near the lower Bollinger Band. But here is the key point. A hammer is not a bottom, it is only a warning that sellers may be losing control for the moment. In a cautious market like this, you need follow-through, meaning higher closes and a reclaim of key moving averages, or the bounce can get erased in a heartbeat. If buyers fail to defend this level, that fear trade can come roaring back fast. To finish the Bitcoin chapter, the MACD histogram is still negative and falling, meaning bearish momentum is actually increasing, not fading. But here is the key point. This is why every bounce in a downtrend feels like a trap, because momentum says sellers still have the edge. In a cautious macro backdrop, crypto does not get a free pass. It usually gets hit first. If this histogram keeps sliding, Bitcoin can drag the whole risk complex into a more defensive, risk-off mood. Now shifting to the real puppet master of this market, let's look at the 10 years Treasury yield, ticker TNX, because this is what stocks are really trading off. The yield is still inside a rising trend channel, and it has now held that channel for 11 straight sessions, which keeps pressure on growth stocks and long-duration tech. But here's the key point. When yields grind higher in an uptrend, the market does not panic, it slowly tightens, and risk appetite quietly fades. With RSI above 50 and rising, the bond market is still not screaming recession, it is screaming stay cautious. Meanwhile, the yield is doing something sneaky. The ATR percentile is at a 20 days low, meaning rate volatility is getting crushed. But here is the key point. Quiet yields can be more dangerous than loud yields because it lulls equity traders into thinking the coast is clear. Then one hot data print or one political headline hits and yields snap and stocks get whiplashed. In this market, low volatility is not comfort, it is tension. To close out yields, this 10-year chart is also flashing a longer-term warning sign. The death cross context is active. But here is the key point. A death cross does not predict tomorrow. It tells you the bigger trend has been weak and the market is still in a regime where surprises happen. In other words, rates can stay stubborn, growth can wobble, and stocks can get hit with those sudden risk-off waves. That is why this market feels stable one day and fragile the next. Now shifting from rates to the dollar, this is the DXY, ticker DXY, the US dollar index that measures the dollar against a basket of major currencies. RSI just exited oversold and moved back above 30, which is a classic early signal that downside momentum is fading. But here is the key point. When the dollar starts stabilizing, it can tighten conditions for risk assets, especially crypto and high beta tech. If the dollar keeps recovering, it adds another layer of pressure to this already cautious market. Meanwhile, the dollar is also flashing a momentum reversal, because stochastic just exited oversold below 20 and crossed up. But here's the key point. When the dollar turns up from oversold, it often creates headwinds for global risk, especially anything priced in dollars. That fits the cautious vibe perfectly, where the market is not collapsing, but it is getting tighter and more selective. If DXY keeps pushing higher from here, it can quietly drain liquidity out of the rally. Now shifting to positioning, this DXY stat is telling you the bounce is not just noise, it has been 24 sessions since the last 5% pullback. But here is the key point. After a long stretch without a real reset, the dollar can stay bid longer than people expect, and that keeps markets nervous. In a world where the Fed is paused but not done, the dollar becomes a pressure valve for global liquidity. If DXY keeps firming up, it can quietly cap upside in stocks and keep risk appetite on a short leash. To close this chapter, the dollar is still trading inside its trend channel, and it has been there for 21 straight sessions. But here is the key point. The channel becomes the map for the next week, because a breakout higher means tighter conditions, and a breakdown means risk assets can breathe again. This is why the market mood feels cautious instead of euphoric, because the dollar is not collapsing, it is lurking. Keep your eyes on the channel rails, because that is where the next macro wave starts. Now shifting into commodities, crude oil is quietly becoming the villain again, and this is WTI, ticker CLTF. The signal shows oil closing in the upper 25% of its range, and it just printed the highest close in 20 trading days, which screams strength. But here is the key point. Higher oil keeps the inflation story alive, and that is exactly what markets do not want when everyone is praying for easier policy. In a cautious tape, rising energy is like pouring gasoline on rate fears because it can push yields and the dollar right back up. Meanwhile, oil momentum is not just rising, it is accelerating because the MACD histogram is positive and still growing. But here is the key point. That is the kind of trend that can sneak up on the whole market, because energy moves slowly, then suddenly it becomes the headline. In a nervous market, stronger oil is a tax on consumers and a headache for the Fed. If this MACD keeps climbing, inflation fears can reignite fast. To wrap up oil, it has now closed above its 50 days moving average for 15 straight sessions, and that is sustained strength, not a one-day spike. But here's the key point. When oil holds above the 50 days this long, it becomes a trend trader's respect and dips get bought. In a cautious macro backdrop, that is a problem for markets hoping inflation cools quickly. If oil keeps riding the 50 days like a floor, rate cut dreams can get pushed further out. Switching to Microsoft, ticker MSFT, the chart is flashing a hard reset. Today's close marked a new 10% or more pullback low on Friday, January 30, with a drawdown of about 20.6%. And this is not some rare accident either. It is the 9th pullback of this magnitude in the last 5 years. That is the kind of price action that makes even the biggest, safest looking names feel like they are skating on thin ice. From here, every bounce gets questioned, because the market just proved it can push this stock lower again. Now look at how the move is behaving. The Bollinger Bands are widening while price breaks out in the trend direction on high volume. The connector here is volatility, because ATR is sitting in the upper 97th percentile of the last 252 trading days. That is a fancy way of saying the swings are extreme, and they can punish anyone who is late or over-levered. In this kind of tape, even a green day can feel like a trap. And the momentum red is not giving bulls much comfort. Bearish pressure is increasing, with the MACD histogram negative for 2 days and still falling. That means the downside force is getting stronger, not weaker. So unless that starts stabilizing, rallies can turn into quick exits instead of real reversals. Turning to Apple, ticker AAPL, the trend structure is sending a warning shot. The stock has been trading below its rising trend channel for 10 sessions, and that lower band is now acting as resistance. The flow matters here because when a former support line flips into a ceiling, rebounds tend to stall faster than people expect. In a jittery market, that is exactly how confidence bleeds out, one failed push at a time. On top of that, the pattern scan is calling a double top with a 76% score. That is a clear heads up that the recent peak zone may be more than just a pause. The connector is psychology. If price cannot reclaim that prior high area, sellers start to treat every bounce as a gift. And today's session was loud. The high to low range was 64% larger than the average of the last 10 days. Still, buyers had control into the close, with price finishing in the top quarter of the day's range. That is a real intraday fight back, but it also screams elevated volatility, meaning the path forward can stay choppy even if the stock tries to stabilize. After Apple's warning shots, let's pivot to Tesla, ticker TSLA, Tesla Inc., where the tape feels even more unforgiving. This chart is blunt. The most recent 10% plus pullback trough was just yesterday, and the drawdown from the mid-December high is roughly 15%. And it is not a one-off either. Tesla has printed 37 pullbacks of that size in the last 5 years, which is exactly why this name can whip a portfolio around when markets get jumpy. With the clock basically reset to day one since that fresh low, the downswing is still unfinished, so any rebound can be fast, but it can also fail fast. In a market that is already reacting to every rate bet and headline, Tesla is the kind of chart that turns nervousness into a full-body tremor. The VIX, the CBOE Volatility Index, has stayed under 20 for 8 straight sessions, and that is the definition of a market that is getting way too comfortable. Right now, it is sitting around 17.44, which screams calm, but calm can flip fast when everyone is leaning the same way. And that is why this chart matters. It is not fear today, it is complacency building quietly. So keep an eye on it, because when volatility is crushed, the next surprise does not knock politely. Before we wrap, here is the high-impact calendar to watch next week. First up, Monday at 3:00 p.m. UTC, the ISM Manufacturing PMI is expected at 48.3 versus 47.9 previously, and staying below 50 still screams contraction vibes. If that print jumps or sinks, rate expectations can whip around fast because this market is hypersensitive to any growth signal. Then Wednesday is the main event. ADP Employment change at 1:15 p.m. UTC is estimated at 40 after 41 last time. A softer read would pour gasoline on the slowdown narrative, while a hotter one yanks the conversation straight back to higher for longer anxiety. And just when traders think they can breathe, ISM Services PMI hits at 3:00 p.m. UTC, seen at 53.8 versus 54.4 previously. Services is where sticky inflation fears love to hide, so any upside surprise there can feel like a jump scare for risk assets. Bottom line, this is the kind of week where one data point can flip the script in minutes, so keep these timestamps on your radar. So here's the bottom line. This is a nervous, late cycle tape where rates and inflation still run the show, and every data print can flip the mood on a dime. Keep your eyes on yields, inflation, and volatility, because moves can get violent fast in both directions. That was this week's stock market report. Tune in next week for the next update. Goodbye.